Now we're going to start Investing 101 in our look at the global stock market. The first thing we're going to start looking at is what is a stock? And all a stock is a piece of a corporation that is owned by individuals. Owners of stock are called shareholders. And a corporation offers stock to the public in order to raise funds. And there are a lot of varieties of things that have come on the TV lately that have shown examples of the stock market. One of my favorite is the E-Trade Golf Baby and the E-Trade commercials. They've done an amazing job talking stocks.
This is weak, man. Frank's trying to not pay me my winnings for the skins beat down I just issued him because his 401k's tanking. It's like, dude, you gotta grab the reins, man. Get E-Trade, do some analytics, do some research, and take charge so I don't have to subsidize your lack of golfing skills. You moved your ball. Frank, it was on the cart path. Why don't you try reading the rules, Shankopotamus?
Get a retirement plan that works.
Again, a good example of the stock market. Other ways businesses try to raise stock or sell stock is to expand their production possibilities. A lot of times it's simply relocation of facilities. This would be an example of like Shutterfly moving to Shakopee or Emerson expanding on previous businesses. A good example is also Buffalo Wild Wings. They had major capital improvement and they needed to raise money to build the stores. So you saw an expanse of Buffalo Wild Wings offering stock. These are some examples of stock values throughout the 1980s to 2012. You see the major value of stock as it's gone up. Again, a lot of times this equals types of recession and recessionary dips. A little recession after 9/11, growth, massive stock market growth, and then bang, the drop of the 2008 banking collapse. And you're starting to see the stock market, world stocks are starting to go up again. Projections for 2013, 2014, we'll see where we go. Shareholders, you guys win. You win as a company starts to grow. As companies grow, their stock becomes more valuable. You need to think of stock as an auction. As people want more and demand for the company goes up, more and more people bid on it. As more and more people bid, the value goes up. Conversely, if more and more people don't want it, they dump their stocks and you lose. But when you are winning, you get something called a capital gain. This is only gains on your value, or the value of your company on paper. You don't make the money until you sell it. That's a capital gain. And it's again paper profit until you sell. And here's just a look at capital gains taxes among other major countries around the world. As you look at Thailand, Taiwan, Singapore, Netherlands, all have 0% capital gains tax, which means if you make money on your sale of your stock, you don't pay taxes. In the United States, we have a 15% capital gains tax. And Denmark, of course, down at the bottom, has a 45% capital gains tax. Shareholders win when a firm is profitable. This is when management will send investors a share of the profits. These profits are called dividends. These are quarterly profits that are based on the amount of money that the company makes per quarter. Is a win guaranteed? Absolutely not. Again, there's no. A stock can fall in value very rapidly, like we saw in 2008 with the financial crisis, and we have depreciation of stock values. If the company does not make any money, there will be no profit and there will be no dividend paid. And another impact that happens after the Great Recession, you saw this peak of $65 trillion in household net worth at $65 trillion net worth, and then the drop down to $49 trillion. You are not guaranteed to make money, but as you can see, the stock value is starting to go up again. Another good example is, again, just look at the total net worth from the Great Recession stock value. It is slowly creeping itself back up. We're getting to the top of where we were back pre-recession. Some stock terminology that you need to have. Stock splits. A stock split is used by a company when the value of the stock gets too high. They will split the stock in half, or a 3-to-2 split. You will do it it is designed to do it to drop stock price down to stimulate demand for that product. Just an example on here is some Microsoft. They had done this back in the early 80s and 90s. If you go to historical prices and you can look at what they've done here Look at their dividend checks. These are quarterly dividends. They send you these every quarter. But down here from 2000 down to 1987, these companies, they split. So if you owned in 87, if you owned 1,000 shares and they did a 2-to-1 split, you would then own 2,000 shares. Here you'd own 4,000 shares. Here then you do a 3-to-2 split, you'd own 6,000 shares. And then 9,000 shares, 18,000 shares, 36,000, 72,000, on and on. And by the time you got to 2003, you would be sitting very, very pretty when it came to the number of shares you owned out of Microsoft. Another term is an IPO. An IPO is an initial public offering. Of course, you should know that guy, Mark Zuckerberg. They offered an IPO for their company last year. It had everybody buzzing. People were looking at it. They were investing in it. It started out really, the value went up really high and then plummeted. Tends to be an IPO, tends to be a really good sign when there's a lot of companies going public, which means that there's confidence in the economy. There's entrepreneurs are starting to open up their company and look for more funds. It's a very good thing. These are, again, some Yahoo IPOs we'll go over later. Bear markets. A bear market is when the economy is performing well below average. Think bears in slumber, really sluggish in the winter. And opposite is a bull market. You like when markets are bullish. They're charging, they're performing above average. 52-week range is something we look at when we compare how this company did over the last 52 weeks in the last year. What was the highest it sold at and the lowest it sold at. When we're looking for companies, we like to see at the low end of the range, always the idea of buying low, selling high, or are they making a charge? Are they continuing to go up? And this is Stock Consultant is a very good website that shows us, for example, is this company bearish? I'm just going to plug in the symbol for Best Buy. I'm going to hit consult. Up here it shows us an overall summary. Right now Best Buy Corporation is 50% bullish, 50% bearish. Not the greatest. You like to have a much higher percentage bullish company. It means they're doing better. Stuff we can look at later. This is just another example of bulls and bear markets as we go through periods of recession, contraction, and expansion. That's historically what we do. We expand, we drop, we expand, we drop. And we will come up and see in 2000 the massive growth we had in the tech boom era of 2000 and the drops we've had since the financial collapse. Just bulls and bear markets. Yields are something we're going to look at when we talk about the dividend income by the stock, by dividing the dividend income by the stock price. We look for high percentages. Yields need to be high. We want to have large percentages of large dividends in relation to the price we have. A PE ratio is just a way of measuring the price of a company and divide it by the earnings. You want to have a small price divided by high earnings. We look for very small numbers, but again, they can be misleading. It's not a number one indicator, but it's a really good indicator on how this company do the last year in relation from its price in relation to dividends. Another symbol is a stock symbol. When you guys go online and start plugging in company names, all of them have symbols like 3M, MMM, Nike, NKE, General Motors, GM. You'll go plug these into Yahoo or into Google, and it'll come up with the information on the company. Volume. This is just the number of shares traded on a given day. I always look for volume and higher, at least than minimum of 100,000 up into the millions, which means that a lot of people are buying and selling that stock on a daily basis. Also, yearly target estimates are excellent indicators of future success. These are just projections on how the company is going to do for the next year. And an EPS just means earnings per share. This tracks the earnings per share over the year or the four dividends for the company. You like to see a large dividend because it just shows you how much you've earned. So example like here, 3M last year. Thing is, $118 per share, very expensive. Its symbol, MMM. Its EPS last year was $6.39 a share. Last quarter, it was $2.54 a quarter. It had a yield of 2.2%. Very solid. Its PE ratio is 18.58, which means if over the next 18.58 years, if it gets $6.37, it will cover its $118.71. Very solid company. Look at it, it had over 2.2 million shares traded overall on average. Today it was a little bit below average at 1.8 million. Very large company. and then we will stop there.